and gentlemen, remember, I will always keep on reminding yourselves that anytime you are given an audit assignment, like for example, we have Aura and Co-op today being told that, hey, you have now won this contract, we have signed an engagement letter. Then, of course, immediately after my entry meeting, getting to understand, in this case here, the organization, it will be very important for me to sit down and do what we call audit planning. Now remember, ladies and gentlemen, that whenever you are given an audit assignment, you shall always treat an audit just like any project. A project has got three key phases. We have a planning, we have execution, and then we have a reporting. Three key phases. So we have, ladies and gentlemen, the planning element, then we have execution, doing the work, and then lastly, we have the concept of what here? The concept of producing the auditor's report. So the same case with any audit assignment. I will be able to plan the work. I'll be able to use the audit procedures to execute the work, collect evidence, and then at the end of the day, I must be involved in the reporting process, which of course has got everything to do with the opinion that I shall be able to give regarding whatever assignment I've done. Ladies and gentlemen, very importantly, and I share the handout. This handout is great. Yeah, so lecture 5, audit planning. 1, audit planning and audit risk. The moment you understand this, then we shall be said to be very, very good participants. So remember, we are always going to treat an audit like any project. And just like every project, you must plan before you execute and report. The same applies to an audit. Everything we do, planning, execution, and reporting, is guided by the audit framework and regulations, which we have already covered in the very first 4 lectures. Now I want to introduce planning, specifically audit planning. I'm sure, ladies and gentlemen, will agree with me that if you attempt something without putting in proper plans, it happens to succeed purely by just luck. Yeah, that is just akin to shooting an arrow in darkness. Yeah, and then of course, if you happen to hit an antelope, then that will be purely by what year? By pure luck, sheer luck. Most of the time, you won't succeed without proper planning. Even if you do succeed, you likely wasted resources because you didn't think through the process with the end goal in mind. That is why audit planning is important. Now, like the other day, ladies and gentlemen, some great lady called me. This lady, she's in some country abroad. So when the architect was designing a house, of course, she's not into buildings, right? She never got to understand the size of the house. Now she started feeling the weight of this house. Once in this case, she started realizing that, hey, 25 million has gone to this thing. What kind of a building is this? When she came over here to look at her building, she was very surprised. It is not the kind of a house she wanted. And that is why, ladies and gentlemen, just like in the construction industry, if you're coming in this case here to put up a building, it will be very important for you to sit down with your architect. You do a plan. I want my bedrooms to be like this. I would want in this case here, these bedrooms to be en suite. I would want in this case here, this bedroom 1 in this case here to be up, others to be down. We do a plan. Once we do a plan, before we start construction, it will be very important for us to have a quantity surveyor. It will be very important for us to have a QS. So the QS, of course, now will quantify our plan and tell us how many lorries of bricks do we need? How many tons of sand do we need? How many bags of cement do we need? Quantify that into money, and then they tell us, hey, you know what? This house of yours will cost you like 30 million Kenya shillings. If you don't have that money, then what do? You scale down your project. The same case with audit. It will be very important, ladies and gentlemen, for us to plan. If we do not plan, We will not be able to foresee our activities. And if you don't foresee your activities, then automatically you are not going to spend your resources wisely, right? You need to know. For example, from the onset, when I'm planning, I would want to understand what we call audit risk. How in this case here, big is the risk that I'm going to encounter in this company. If the risk is very big, then I'm going to put in more audit procedures. I'm going to do more audit work. So it means in this case here, for example, I would even need a very, very experienced auditors. Yeah, audit seniors, all right? When I'm planning, I'm able to know who is going to do what, who shall be auditing inventory, who shall be auditing, in this case here, PPE, all right? So it will be very important, ladies and gentlemen, from the onset for us to do what here, to plan this work very well. If we don't plan the work very well, then what is going to happen? We are going to give an incorrect audit opinion. We are going to give an incorrect or inappropriate audit opinion. If you don't plan very well, then for sure, there are some misstatements that you'll not be able to identify during your evidence collection. So planning is really key. Remember, audit is all about planning, execution, and then of course, reporting. So even if you do succeed, I'm just repeating this, you likely wasted resources because you didn't think through the process with the end goal in mind. That is why audit planning is so important. Why do we need to plan an audit? Why don't we just go to the client and start? Because we want to be successful. This is why we need an audit. We want an effective and an efficient audit. Effectiveness means achieving our objective to issue the correct audit opinion on the financial statements. Efficiency means using our resources wisely, avoiding wastage, using neither too little nor too much. Resources include the time to be spent, people, and tools. These are critical in audit planning. Let's build these concepts gradually, ladies and gentlemen. As mentioned, we plan because we want our audit to be effective and efficient. And that means issuing the correct opinion, one that truly reflects the state of the financial, the state of the financial, the state of the financial statements. Benefits of planning. Adequate planning helps to ensure, these I've always seen it in your exams. Adequate planning helps to ensure that attention is paid to the important areas of the audit. Attention is paid. Attention is paid to the most important areas of the audit. Ladies and gentlemen, assuming, like I'll be teaching you later on, that we shall be going for what we call risk-based audit. Then when we plan very well in advance, we shall be able, using these analytical procedures, we shall be able to ascertain like which areas are risky, which areas are more risky, which would want our biggest attention. All right. All right. So basically, whenever we talk over benefits of planning, the first one is that through proper planning, we shall be able to focus all our energies into where we are needed, in those areas where we are needed most. Yeah, so attention is paid to the important areas. Then we have number two, potential problems are identified and resolved on a timely basis. The audit engagement is organized and managed in order to be performed in an efficient and effective manner. Because of our planning, we are able to organize and manage our audit effectively, efficiently. Work is properly assigned to individual team members, reduces the risk of giving the wrong audit opinion. Let me read your chart, ladies and gentlemen. a great question over there, which I'll be able to explain later, the concept of buying audit opinions, which is really, really unethical, but I'll be able to talk about that later, Elizabeth. Great. Now note, failing to plan may lead to issuance of a wrong opinion, which now leads us to introduce the concept of audit risk. Now, ladies and gentlemen, first of all, I would want you to know the meaning of risk. When, for example, you earn your dividends, you've earned your dividends, after you earn your dividends, ladies and gentlemen, what will happen? You may get, for example, some good monies. Once you get these good monies, you decide to send this money to go and look for more money for you. For example, you've gotten like, say, 10 million Kenya shillings. So in short, in this case here, you may decide to do what? To invest this money. You send the money so that at the end of the day, you'll be able to get your money back plus maybe interest. But you see, when you send this money out there, you are exposing your money to risk. There are chances that this money may not come back, or it may not even come back. It may not come back totally, or it may come back in terms of what you're being little than you expected. So when you talk of this money being exposed, the money being exposed to risk, that is what we mean, the concept of what here, putting your money into danger. Ladies and gentlemen, when we begin our auditing, we'll always be faced by what we call audit risk. There is the danger that we may give a wrong audit opinion. We shall be seeing later on, ladies and gentlemen, we have got various types of audit opinions. For example, we have what we call unqualified audit opinion, unqualified. Then we have, for example, what we call adverse. So like unqualified audit opinion, this is the best audit opinion. We are telling the whole world that the financial statements of 𝐅𝐶𝐸 portray a true and a fair view. That is unqualified. The financial statements of 𝐅𝐶𝐸 portray a true and a fair view status. That is good. I will want us to put this in summary for you to understand, because I'll be having a whole topic where I'll be talking about reports, audit reports. And then adverse now is the worst form of audit opinion. Under adverse, we are saying that now the financial statements of XYZ Limited do not portray a true and a fair view. They are fake now. They are bad. Now, ladies and gentlemen, remember audit. We do audit through sampling. We put in our audit procedures in the samples that we collect. If we are not careful, the financial statements could be having errors, could be having misstatements. If we are not careful, fine, you'll be able to collect great evidence. But if you are not careful, these financial statements that have misstatements in them, you see, at the end of the day, if they have material misstatements in them, and those material misstatements are what we call pervasive, huge, like a pavada, huge. If they are huge, then you're supposed to talk over adverse. But you see, as an auditor, there is every likelihood that you may put in your very best in terms of audit procedures, but at the end of the day, even if these financial statements are misstated, instead of you giving an adverse opinion, there is every likelihood that you may give a good opinion. You may give an unqualified opinion. So if you give an unqualified opinion in a situation where you should have given adverse, then that is the kind of a danger we are talking about, which we call audit risk. So what is audit risk? Audit risk is the risk that the auditor will give an inappropriate opinion on financial statements that contain a material misstatement. I repeat, it is the risk that the auditor will give an inappropriate opinion on financial statements that contain a material misstatement. A clean audit opinion typically states that the financial statements present a true and a fair view with no material misstatements. That's a clean audit opinion. However, if the auditor misses a significant error, when you are perusing through your financial statements, your evidences, if you miss a significant error or a misstatement and still you issue a clean opinion because you missed that error, then the audit has failed. That risk that the auditor will fail to detect such material misstatements is what we call audit risk. Planning is one of the key responses to manage this audit risk. So, ladies and gentlemen, I would want to see whether you guys are following. In your own words, if you're told to describe audit risk, what will you be able to tell us is audit risk in your own words? So I'm waiting for you to type there in your own words. If you are asked in an exam to describe what audit risk is, what will you be able to tell us is audit risk? There's so many ways of defining this, ladies and gentlemen. Remember, risk is also a probability. It is that likelihood that I may issue an inappropriate audit opinion, an incorrect audit opinion over financial statements that are materially misstated. So somehow, ladies and gentlemen, are we together? Could you kindly confirm there by mentioning yes or no? Are we together? Are we together somehow? Yeah, great. Thank you so much. Then let me continue. Now, ladies and gentlemen, we have three components of audit risk. This audit risk normally comes in three components. Audit risk consists of three components. We have inherent risk, control risk, and then number three, detection risk. We are saying that audit risk equals inherent risk plus control risk plus detection risk. So anytime you hear of audit risk, remember it has three components that must be summed together. We have IR, CR, and DR. Let's discuss each one of them. We start with the inherent risk. Ladies and gentlemen, inherent comes from, or rather means what here? Innate. Yeah, INNATE. Yeah, the risk that is basically inside the business. The risk attributed to the kind of business that you are auditing. All right. You know, there are businesses that are inherently risky. Yeah. And I told you, for example, ladies and gentlemen, as Aura and the company, of course, you guys, by now, you know that I run a licensed audit firm in Kenya here, going by the name Aura and Company, based at Westlands, Havenscott. If today you are to give me, ladies and gentlemen, like a circle to audit, regardless of how big it is, I will not take that assignment. Even banks, I will not take such kind of assignments. Why? Because these are businesses that are inherently risky. I mean, we know that they are handling, we know that their stock is money. And if their stock is money, then automatically they are prone to what here? To theft. From insider stakeholders, we have in this case here people from outside. All the best thieves normally will go for those kind of business. So as an auditor, you could come in with a very, very good audit procedures to audit this particular circle. But because of the nature of business, which in this case here, ladies and gentlemen, happens to be moving very fast. Look at, for example, 𝐂𝐨𝐿 in Kenya here. 𝐂𝐶O used to be the umbrella body of the circles. Who knew that 𝐂𝐶O today could be on its knees? That is the concept of inherent risk I'm talking about here. So inherent risk, ladies and gentlemen, is the risk inherent from the word inside, nature. Yeah, inherent risk. This is the risk inherent in the nature of the business or industry. It is related to factors such as for tech companies, technology companies. Yeah. Rapid changes in technology and obsolescence. Yeah. In fashion, trends and demands shifts. So you're in this case here looking at auditing a company like Mountex. If you know Mountex, the one that makes clothes based in Nanyuki. They will come one day, they have produced a very beautiful, and by the way, you never told me that my shirt is very beautiful, you guys. Yeah. One day they have produced shirts like this. So they start in this case here getting huge demand, huge profits. Within no time, this kind of an attire gets out of fashion. So the business in this case here, revenue crashes at once. That's a very risky business. All right. Very risky business. Business that goes with fashion is very, very risky, inherently risky. The same case here with technology companies. Look at, for example, this company called Kodak. Kodak is one example of a company that was overtaken by technology. If you remember, if you're quite not very old, we don't talk of old, but I mean, if you were there in the 90s, early 90s, or even late 90s, or early 2000s, you remember somebody used to come to your homes and they used to take photographs of you guys on Sundays, if you remember. And then they would go and do their abracadabra with those whatever. Yeah. And then they return like after a week or even after 2 weeks with now your very good photos. The ones you used to take doing like this. Yeah. Yeah. When in this case here, Samsung started producing phones that were able to produce digital photos, Kodak rubbished them. Kodak still stuck with the old technology. All right. Your guess is as good as mine. One day, the management of Kodak came to a press conference and they said, hey, you know what? We have now become bankrupt. We are no longer able to continue the business because, I mean, the population outside here, especially our young girls, we call them baby girls. These are people who would want to take, in this case here, a snapshot like 1 second. The other second, it's on a Facebook. Who would want a technology at this era where you take me a very good photo and then you give me back this photo after a week? So technology. So you can imagine now the auditors of Kodak over that year. Of course, Kodak used to be a behemoth, a big company. Yeah. So the auditors of Kodak, of course, during that year, they must have given a very good audit and qualified opinion. So remember, when you give an qualified opinion as an auditor, you're also saying that this company will be with us for a long time. You're kind of giving an assurance regarding longevity. Yeah, we talk of going concern that this company will be there for at least the next 12 months minimum. We are guaranteeing kind of, not guarantee, but I mean, we are giving some kind of a comfort. But now here you are, you've done your audit, and then this particular audit, or rather this particular company's products become obsolete. They become obsolete. When they become obsolete like that, ladies and gentlemen, then, I mean, that is the kind of business here. These tech companies in this case here are prone to this concept of obsolescence, being overtaken by events. Like, for example, if you are auditing, say, YouTube, of course, I know YouTube is a huge engine, but if you look at the trends currently, I mean, people are doing more of TikTok than YouTube. Yeah. Inherent risk, the risk attributable to particular businesses, given what are the nature of activities that they engage in. They're automatically businesses that are inherently riskier than others. All right. So like in real estate, exposure to economic downturns. Yeah, you can imagine, ladies and gentlemen, like if you look today, I mean, which real estate company is really advertising so seriously? None. Because currently, of course, not in Kenya alone, but globally, ladies and gentlemen, we are seeing an economic recession. So people do not have that purchasing power. So an auditor, you can go ahead and give an qualified opinion, and then this real estate firm crumbles down. And then people will blame you because people don't understand this concept of inherent risks, the risks attributable to some kind of businesses, given the nature of what are their activities, given the nature of their activities. All right. So in banking, credit and loan, default risk is normally very high. Inherent risk is shaped by industry dynamics and is not controlled by the auditor. It's not controlled by the auditor. Then number two, we call what we call control risk. Ladies and gentlemen, please allow me to explain something. Later on, we shall be having a whole topic to discuss what we call internal control systems. So internal control systems are the safeguards that you put in place to ensure that the assets of the company are not misappropriated. Yeah. So remember, that is a role of the directors. The role of management is to put in padlocks all over, to put in safeguards all over, to ensure that the company runs its business on a day-to-day basis in the interest of the shareholders who don't want assets to be used the way they never intended. So those safeguards that you put in place are the ones we are calling what here? Internal controls. So basically, a control is an umbrella. Yeah, an umbrella that you put on top of a company so that this company is not rained on. Yeah, an umbrella. So as an auditor, when I go to audit any company, among us, those very first things I will do during the planning phase is to assess how strong is this umbrella, how strong is this internal control system. Very few companies globally have got very strong umbrellas, very few. Most of the companies in this case, you'll get in this case a big old man like myself here, all right? Working with an umbrella of a young kid, yeah, which can't even barely cover my baldness like this. So this side is being rained on like that. Poor internal control systems. All right. So in this case, you are putting just something very, very small to cover the assets of the company. Poor internal control systems. Now, ladies and gentlemen, please listen and listen to me very well. You could be having very strong umbrella, very strong control systems, but at times, in this case here, misfortune happens that you had put in the very best goalkeeper. You had put in the very best goalkeeper, all right? But this goalkeeper, when it came to this penalty shot, he could not do anything. Yeah, he tried his best, but given how this player kicked this ball, and I mean, perhaps he was also assisted by wind, this guy could not even barely move. There are times these internal control systems that you put, however strong they are, they may not be able to detect any misstatements. Control risk relates to the company's internal control systems, the policies, procedures, and the processes put in place to prevent, detect, or correct errors or fraud. Control risk arises when controls are absent, you don't have any controls. When controls are poorly designed, when controls exist but are not properly implemented. All right? All of this leads to control risk. The risk that controls will fail to detect or prevent misstatements. All of this leads to control risk. The risk that whatever controls, ladies and gentlemen, you have will fail to protect, or rather to detect or prevent what we call these misstatements. Ladies and gentlemen, at times you can try. At times you can try and try and try your very best, but in this case here, issues can arise. If the controls that you have in place are not able to detect or prevent misstatements, then that is what we call a controls danger. Risk is another term for danger. A control risk. Now, ladies and gentlemen, if you allow me, I will be able to go to the third risk. But before I go there, I can see some comments. I always like reading comments. Yeah, Great. Great. Thank you so much, Patricia. We shall overcome. Elizabeth, thank you so much. Great. We shall overcome. We shall overcome. That brings us to early auditing and modern auditing. Yeah. So then we continue. Now, detection risk. Detection risk. This is the auditor's own risk now. The risk that audit procedures will fail to detect a material misstatement. Unlike inherent and control risk, detection risk is within the auditor's control. It is affected by poorly designed audit procedures, human error or omission, lack of training or experience on the part of what year, on the part of the auditor. Ladies and gentlemen, please listen and listen to me very well. That the inherent risk and the control risk, these are risks attributable to what year, that company. Yeah, there is a risk attributable to the nature of the business. Then there is a risk attributable to the controls that these people are putting over their systems are not able to detect or prevent misstatements. So that is basically beyond the control of who? The auditor. But now also the auditor has his own kind of danger. The auditor is coming in this case here also to put traps. They put traps. Not like those traps that were being put by somebody at State House. No, traps like that. But there is a chance that that trap may not be able to detect the misstatements. So as the auditor is putting in his audit procedures, as I told you, regardless of how good you are as an auditor, there are those things that you will be able to miss. Yeah. So you're putting, in this case, your traps like this. There are those things which will bypass your traps and go the other side where you never expected. All right. So then, ladies and gentlemen, the audit risk is the risk that the auditor may not be able to detect such misstatements using his very well crafted audit procedures. When you talk of audit procedures, I'm so sure somebody may be wondering, what are these audit procedures? Like what we call substantive. We shall be looking at those. They are not things that are really far away. We shall be looking at things like, for example, we call them 𝐅𝐸𝐸𝐸. 𝐅𝐸𝐸𝐸. Yeah, like is a very good procedure. It's called analytical procedures. Analytical procedures. So under analytical procedures, for example, ladies and gentlemen, I will be able to look at the trends. So I will be able to look at the trends. Yeah, I'll be able to look at the trends. Yeah, compute the ratios. Once I compute the ratios, then I will be able to discern the trends. Yeah. So for example, I'll see like for the last 4 years, my average revenue growth has been 10%, 10%, last 4 years. But on the 5th year, we realize that our growth is like 200%. You know, that's abnormal. So we need to put in our very best tests on year 5 to see why as this revenue grew by 500%. Have these guys, for example, gotten into money laundering? Yeah, because there must be something. I mean, which kind of business will be able to give such a high rate of increase of revenue? So as an auditor, I'll be able to put in those 𝐅𝐸𝐸𝐸s. But as much, I'll be discussing that in full later. As I put in all those procedures, ladies and gentlemen, trust you me, there is a very big possibility that still I will not be able to catch everything. I won't be able to catch everything. There will be things that I will miss. There's some misstatements that I will have. And those misstatements that I will have is what we are calling, ladies and gentlemen, the detection risk. This is the auditor's own risk, the risk that audit procedures will fail to detect a material misstatement. Unlike inherent and control risk, detection risk is within the auditor's control. It is affected by poorly designed audit procedures. We are also human error or omission, lack of training or experience. Detection risk can be managed and reduced by performing sufficient and appropriate audit work. Now, ladies and gentlemen, I would want to know whether up to here you guys are with me. I would want to know whether up to here You guys are with me. Are you able to follow really, really? Are you able to follow? Thank you so much. I can see great responses there. I can see great responses there, which is really good. In summary, we have said that we have got three types of audit risks. We have inherent, we have controls risk, and then we have detection risk. The only risk that the auditor can manipulate, can jog around with, can influence, that he has got powers over, is the detection risk only. The other risk in this case here, the other risks are beyond him. They're beyond him. So then, how should auditors respond to these risks? You cannot control inherent risks or control risk. These two, you cannot control them as the auditor. They're external to the auditor, but you can respond to them by adjusting detection risk. You can respond to them by making changes to the detection risk. I mean, ladies and gentlemen, you may not have understood anything that I've taught, but this is something that I would want you to go home with. That you as an auditor, you cannot control inherent or control risks because they are external to you as an auditor. You're not the one who is charged with the responsibility of putting in controls of a company. And the nature of a business that these investors get into is their business. You've got no control over that. They're external to the auditor, but you can respond to them by adjusting detection risk. If inherent and control risk are high, this is it now. You must reduce detection risk by doing more audit work. Ladies and gentlemen, if inherent risk and control risk are very high, and then you realize now there is a very high danger of me giving a wrong audit opinion, what do? Then I do a lot of work. I increase my detection risk. Yeah. So if inherent and control risks are high, what am I supposed to do as an auditor? I also go up to match them. Yeah, to counter them. Remember, I've told you that this detection risk is the only thing that you can play around with. When the inherent risk and the control risks are normally high, what do we do as auditors? We increase the detection risk. Great. If inherent and control risks are low, detection risk can be allowed to be medium, and you may do less extensive work, e.g. more reliance on analytical procedures, fewer sample sizes. Now, ladies and gentlemen, one thing that I would want to tell you is this. When you increase your detection risk, as an auditor, it means doing a lot of work to be able to detect issues. Detection risk is high there. An auditor will do a lot of work. When I do a lot of work, it means what here? More resources. And that is why, as an auditor, one thing that I'll always do in my planning stage is to evaluate what we call internal control systems. When I evaluate internal control systems and then I realize they are working, what do? I will be able to reduce my sample size, audit fewer things. Yeah. And then I say that I'm relying on the strength of the internal control systems. And that is why you are told, remember, it is the duty of the directors to institute, to put in place strong internal control systems. When you put in place strong internal control systems, then the auditor will do little work. The auditor will do little work. If he does little work, what does it mean? Because mostly our monies are, especially disbursements and etc., they're pegged on the number of hours that we put in the business. As you keep on traveling, being in your business for long, then we invoice more. We invoice more. All right, let me repeat. If the inherent risk and the control risk, if the two of them are high, I have to do a lot of work. So I'll have to invoice a lot of money from this company. But if this inherent risk and control risk are low, then to be able to be fair also to the organization, and because I'm now going to rely on the controls that are working, and that is why the risk is low, then it means that I do little work. But now remember, detection risk, you can't talk of detection risk being low. You can't take it towards zero. Yeah. So we talk of what here? Medium detection risk. Again, you can't say that now we are auditing Safaricom. It is so strong in internal control systems that now our detection risk will be zero, will be low. No. We can only take it down to medium. Ladies and gentlemen, I don't know. I feel that this is quite a tough one, but is there somebody who has understood something in this case here about this inherent risk, especially inherent risk, control risk being high? When they are high, the auditor has to do a lot of work. And that is why the auditor must always keep on, in this case here, doing what he are doing, testing the internal controls. And remember, the internal controls will be given to you, the procedures will be given to you by management. So if it's a college like RCM College, we have a soldier at the gate. When you go to RCM Stand Bank house, first floor, we have a soldier at the gate. So this soldier at the gate is supposed to be looking at the receipts that students come with. Yeah, so that before we give you permission to go to class, have you paid fees? We check. So then if you tell me I will run the company to go and audit RCM Stand Bank to test whether that control is working, what I will do, I'll simply come and pretend. Of course, I will send somebody else, right? Just somebody to go and pretend that they are on their phones throughout. They are surfing on their phones, but they are looking keenly to see what that soldier is doing. Are there times a student comes and he's let to go to class without the receipt being checked? Are there times in this case here, for example, a beautiful lady just comes and walks around, instead of giving a receipt, she gives a smile. And then, of course, that smile is her passport to get to class. If that happens, then I know that the internal control systems are weak. So if they're weak, then it means automatically that internal control risk is very high. If that risk is very high, then as an auditor, I will be forced to do what we call substantial work. Substantial work is what we call substantive tests. Substantive comes from the word substantive. You do a lot of substantially. You do a lot of work. So whenever inherent risk, internal control risk is very high, what do? Our detection risk will be high. If internal inherent risk and the control risk are low, then our detection risk will be medium. Will be medium. So I hope, ladies and gentlemen, that makes some sense. Does that make some sense to you? Does that make some sense to you? Does that make some sense to you? Great. And by the way, I never told you that you are enjoying these free sessions courtesy of our employees at 𝐂𝐼𝐼. Yeah, they are also inside here. I just felt like they need to be in a formal audit classroom so that we can have like a uniform way of auditing across. So I read note for our audit firm, you guys would not be getting this particular sessions. And also we would want to thank our students. I mean, I don't know whether there is any single engagement we have gotten at 𝐂𝐼𝐼, either to do audit, tax, or advisory, which has not been forwarded to us by a student. Yeah, so students in this case here, they are playing a big role to the growth of our audit firm. That is why great. Thank you so much. Great. So we're almost finishing. So later, you will be able to learn. Yeah, later, you will be able to learn. No. Your goal as an auditor is to keep detection risk low enough so that when combined with other risks, the overall audit risk remains at an acceptably low level. If you are new to this subject, just keep this principle in mind. The higher the risks you can't control, the more audit work you must do to reduce the risk you can control. The higher the risks you can't control, the more the audit work you must do to reduce the risk you can control. Later, you'll be able to learn that more audit work equals more detailed substantive testing, smaller materiality. Less audit work, more reliance on analytical review, larger sample sizes, higher materiality. Now, ladies and gentlemen, please listen and listen to me very well. Materiality is a point of significance. It's a threshold. So if I would want to do a lot of audit work, then it means that I test more transactions. I test a bigger number of transactions. How do I test a bigger number of transactions? By ensuring that this threshold is taken very, very low. That doesn't make sense. Even myself, as I explained, I know things that do not make sense. Assuming we have our financial statements, balance sheet, statement of financial position at the 𝐅�RCM College. So we have assets worth 10 million. We have liabilities worth 20 million. We have equity worth 30 million, just putting figures. If, for example, I say that my materiality level is 25 million, it means that I can only probe further, I can only investigate those account balances that are worth more than 25 million. So it means that then in that case, the only thing that will be material will be equity, which is 30. All the others will be immaterial. Remember, for us as auditors, we only work with material values. Those are the values of significance. Anything that goes below, that is lower than our materiality, is very, very small. We don't, in this case here, audit. So for now that we haven't reached that topic, and I thank you because you're really struggling with me, this is going to become very simple. But for now, I would want you to appreciate, ladies and gentlemen, that whenever you are asked to do more audit work, that will be equal to its substantial, so substantive test, the 𝐷𝐴 will be big. And ladies and gentlemen, the materiality level will be small, so that you get to audit more account balances, many account balances. Yeah. But in this case here, when they tell you that you're going to do little audit work, if it's little audit work, ladies and gentlemen, I will basically do the ratio analysis, what we call analytical procedures, the ratio analysis, analytical procedures, and then, ladies and gentlemen, I will be able to do, very little work. The materiality level also will be up there. So that I can only test like 2 or 3 balances. Now I'm left with only 3 minutes, finish. Only 3 minutes I finish, then we get into another business. Executive summary, just for you to be able to appreciate, ladies and gentlemen, what we are talking about. Yeah, executive, before we go to lesson 6 will be done another day. In total for practical, I normally do 43 lessons. So I don't know when we'll be able to finish this, but I normally do 43 lessons for me to be able to give you a certificate of like internship that you have been with us. If it's internship, if you're an intern at 𝐅𝐿&CO, you must go through all of them and do an exam. We're that serious with this audit. Yeah, executive summary. Auditors face 3 types of risks during an audit. Inherent risk. The business is naturally risky, like a technology or financial company. Control risk. The company's own systems might not catch mistakes or fraud. Detection risk. The risk that you, the auditor, miss something important. Now, you can't control the first 2 as an auditor, inherent and control risks, because they are part of the company's environment or how it runs. It is run. But you can control detection risk because that is about how careful, thorough, and smart you are in your audit work. So here is how to respond. If the company is risky, high inherent control risk, you need to be extra careful. If the company is risky, high inherent control risk, you need to be extra careful. This means do more audit work, test more samples, use lower thresholds so that you can get to probe or audit many transactions, low materiality, do detailed testing, what we also call substantive tests. If the company is not very risky, what we call low inherent control risk, you can relax a little, because the chance of bigger errors is smaller. So you can do less work, use fewer samples, rely more on general trends and patterns, what we are calling analytical procedures. In short, more company risk, more audit work. Less company risk, less audit work. That is the end of this lecture number 5. So I'm looking forward to doing lecture number 6 with you later in the day, because I would want to finish these guys who are working at 𝐂𝐿&CO. I would not want them to really stay studying forever. I would want to finish all the 43 sessions in a week. So if you're keen enough, I'll be able to